I'm finishing my lunch, so I might put myself on, stop my video for now, just for a minute.
Fair enough.
Matt, I think we're only waiting on Todd.
Yep.
I don't know if you heard from him or not.
I did not hear from him.
There he is. It's coming on.
There's no snow at Todd's house somehow.
Sorry, guys. I'm having, which is always great for a day like today, but internet difficulties. So it's been going in and out all day.
No worries. Thanks for jumping on. I think we've got the full team here, so we can jump right in. Dan, thank you for circulating the revised minutes. I saw those come across a little earlier this morning. So if I can, I don't know if there was any questions or comments on the minutes, and if not, if I can get a motion to approve the November 17th minutes. I see a motion. Thank you, Brian. Can I get a second? All right, seconded by Linda. All in favor? All right, we have 4 ayes. That was easy enough. Well, we kept today's agenda pretty wide open. I think we wanted to, the intent is really to do 2 things. One, to leave some room for discussion, any Q&A, questions that folks may still have for the city staff, and also room for discussion about open items, but also to walk through our draft recommendations as we're trying to put into final form what we'd like to recommend to the broader committee. Dan was kind enough to attach to the agenda. So for those of you who did get the agenda, if you pull that up, you'll notice that attached to the agenda are the initial draft recommendations, the preliminary recommendations that were circulated on the 17th. And I've received a few comments back from folks that are not layered into these recommendations. One of them was kindly correcting my spelling. Apparently I failed to use spell check here. So I appreciate that. I want to make sure I spell the word recommendations correctly when we go final on this. But there was a couple of substantive recommendations to this iteration that I'll share with the team as we walk through them. But before getting to those, I guess I would just open it up for discussion on these items, starting with the capital stack, which I've laid out a few thoughts that we've iterated over the past months regarding the capital stack, and would like to hear back from the team, whether there's questions, comments, recommendations here on the capital stack recommendations.
So Matt, do you want me to share the comments that I had in that area to start, or how do you?
Yeah, sure, Linda, that'd be great. Linda had some good clarifications layered in there, and I think at least one substantive comment regarding the bond rating. So do you want to share with the team those thoughts? That'd be great.
Yeah, it'll give us maybe a place to start from. So I just added in A, the first one. I said, in light of current and projected availability of other funding sources. And then the rest of it seemed fine. And then in B, I said, leveraging TIF proceeds, community center office lease revenue, community center office lease revenue, and bed tax to pay debt for a community center. And what did it say before, Matt? To raise debt, I think. And that was confusing to me, but maybe that was okay.
If I can share my screen here, Linda, I will. Do you mind if I just show you a red line?
Oh, sure.
Okay, let me see if I can do that here for everyone. Make it easiest. All right, here we go. Can everyone see that?
Part of my motivation was in changing words was to try to be looking at this from the position of a resident who hadn't been involved in all of the discussions and maybe wasn't totally involved you know, the funding mechanisms of cities, et cetera. So I just tried to make it more regular, everyday words. So that was B, when I said then tax to pay debt. And then in C, just clarified reserves in excess of the 30% operating expenses threshold recommended by City Council for capital funding. And then I thought deleting substantively and just saying that it does not negatively impact the city's bond rating would be further clarification.
So I thought these were really helpful clarifications. I did just wanted to put the question out there with regard to the bond rating. I mean, I think maybe Dan or the team can comment on this, but my assumption is that the city issuing this much debt may impact the city's bond rating. And I think where we certainly want to be cognizant and careful around any impact that would have a material impact on interest rates or the ability of the city to raise future debt. I guess I'm not familiar enough with the bond world to know, though, if moving from an A to an A- rating would do that, or kind of maybe the city can speak a little bit more about what they foresee as the potential impacts on the bond rating and what that would mean financially for future decisions of the city.
And I think Brent Lewis is on this call. I want to see if he wants to jump in here.
Sure, I will. Good question. So it's really hard to tell on the impact of the bond rating, because essentially the rating agencies could change their metrics today or tomorrow and change our bond rating. But in all likelihood, issuing, up to $80 million in debt, which that number includes the Kingsdale, the parking at Kingsdale, the community center, the office, and also the Arlington Gateway project. It's more than likely that our bond rating could be impacted. We don't know that for sure, because a lot of people would say projects like this are what a AAA city should be doing. They should be helping bolster their economy and do economic development projects like this. But really, the difference between being AAA rated and one notch down, it's minor at this point. I don't have numbers off the top of my head, but it's minor. We had a meeting with our municipal advisor just last week with city manager Shoney was involved in it as well, and we had a discussion just about this, and this is pretty much how the discussion went. So it's likely that we will get notched down, but it's also likely that it may not be because of the community center. It may be notched down when we go to issue debt on the Gateway project, or if we just go issue debt on the Kingsdale, parking lot. Because every time that we go, even though that these debt issuance may be backed by not our GO, not our full faith and credit. We've talked about non-tax revenue pledge. We've talked about income tax revenue pledge. But every time we go to the rating agency to have those special debt issuances looked at, they also reaffirm our general obligation AAA as well. And that's where we could see the move down off AAA. Now, with that said, they are aware of the Gateway project. So when we go issue debt, we have to disclose all these future issuances. They are aware of the Gateway project, but they are not aware of the Kingsdale and the community center office component of issuing debt, because we didn't know the last time we issued. So,
Brent, do you want to touch on the evaluation for these economic development projects? And we typically see ratings that aren't necessarily AAA associated with an individual project. You may have touched on that, but
yeah, it's a good point. So just so you know, so when we go out to issue debt for our regular capital improvement program, that's typically going to be general obligation debt, and that's what's rated AAA. So when we went out, and I think we discussed this at a previous meeting, we went out and issued debt for the Lane 2 project, and that was backed by non-tax revenues. So anything essentially that's not backed by general obligation is going to get notched down one grade. Now there was given our low interest rate environment, there was very little impact on the interest rates. We were still right around, I think, 2%. But that's essentially, that's what your Moody's and your Standard & Poor's are going to do with these non-geo backed issuances, is they're going to move them down a notch. Now, one thing that's interesting is that when we went to S&P, they rated our non-tax revenue issuance AAA, which is actually believed to be one of the first issuances like that in the state to get rated AAA. And a lot of good, a lot of flexible, good policies, we have good finances, and our backstops in these economic development deals are top notch. I think Steve mentioned that at a previous meeting.
Yeah, and I guess one other thing I would add to all that is, what we have seen from the rating agencies is that they're not predictable in some ways. So they will look at this, and as Brent and Dan alluded to earlier, they'll look at it and say, on the one hand, they want you to be making the investments that are toward the future and make the community continue to be attractive and all those things, but they don't want you to spend any money doing it. So there is, that said, they recognize the balance they're asking you to make. And so I think they'll look at it and make that balance. We've said from the outset that we want to be very transparent about what the risks are. And this is a risk that we've got to balance. Well, there is a risk here that by taking this forward, we could see modest increases in our debt costs going forward. That's really the impact of a downgrade, is a modest increase in borrowing costs at a future date. Is it a guarantee that that's going to happen? No. Is there any way to know how much that's going to be? No. But that is one of the risk factors that has to be weighed as you look at this.
Yeah, and also when I do my budgeting for these CIPs, I use very high rates, 3.5% to 4% rates, when we've been nowhere near there. So that gives us a little bit of wiggle room when we actually go issue debt for these projects.
So I know they're all estimates, but could you maybe give us kind of a parameter of what if there was a modest downgrade, your cost of capital goes up, what, 10, 20 bips, 40, 50? What's that range, Brent, that you would anticipate? Just trying to flesh that out a little bit.
My guess is the 10 to 20, not the 40 to 50. It's right now, it's not very much. Now, obviously, between now and when we go to issue debt on these items, things could change. So.
Matt, I think that this is excellent dialogue, Linda. Thank you for bringing it up. As a general matter, on terms of recommendations, I default to positions that provide that aren't quite as black and white as negative, and would prefer a word like materially negatively impacts the city's bond rating, just because of all the various factors that have been articulated here. And if it's black and white, it will be hard for the city to manage.
I agree with Todd. I think you can't put this forward if we have negatively in there, because we know that is going to happen. But if it's a managed number or a known number, or an assumption that there will be a negative impact, what word can you use just to say a managed impact or something we're aware of? But you can't use negatively then, because it would make it incorrect, or it would not be true any longer to say, because we know there will be a negative one, but an assumed or manageable one. I'm not sure if you go back to substantively and use that.
Materially negative, is that what you were thinking, Todd?
That is certainly one option.
But it will be
Or just materially impact, I guess. It's assumed that's negative, not a positive.
I mean, I do think materially negative provides flexibility, and Steve and Dan and others can opine on this from a management perspective, but material would allow you to say, hey, our bond borrowing costs are going up, 40 basis points. We don't believe that to be material. But we could, it's worth a discussion whether it says materially negative or materially affect the city's bonds rating.
So here's the challenge in this. What you're asking for is an unknowable, right? We're going to have to make decisions before we know what the bond rating agencies are going to do to our debt ratings. And so, that's one challenge is, and that's the same thing. That's the same way with anything. I mean, we make decisions on our capital improvement program before we know for certain what the impact is going to be on our debt. Now, if you wanted to, if you wanted to get specific in this, I suppose you could look at, setting a threshold of, not more than, I do think materially leaves a lot of leeway, which I like, but also there are parts of me that I don't, parts of me that doesn't like that, because it's then, a half a grade downgrade, going from a AAA to AA plus to someone is going to be material, to others it's going to be immaterial. So yeah,
I mean, the way we've approached that sometimes, Steve, is to say who gets to decide materiality. So you could add in the the city's reasonable opinion, or in the city's opinion doesn't materially. So it's then, who's ever acting on behalf of the city is the standard. Would be one option. I guess an alternate approach would be to give some type of range at which the city could borrow for this project and not get into the future bond ratings, which could be impacted both by this project, by a bunch of external factors.
Yeah, I think the other, the other way to think about this, and we can work on some formulations on this, is to think about it in terms of coverage ratios, and looking at it from that perspective. So, maybe not focusing so much on the rating itself, but looking at, what are some of those kind of best practices coverage ratios that we could look at. Because again, I think there is, and we can go back and refer to some of our kind of core financial policies. Brent, thinking about the work that you just did with the financial team with council, and looking at kind of our core borrowing principles. I don't know if there's some of those that you think we maybe would give some options for the subcommittee to point to, kind of maintaining consistency with a few of those things.
Well, yeah, I mean, there's when it comes to this, I mean, we always have to meet our core policies, and the one really related to debt and related to the projects, like our CIP would be our 2-to-1 debt ratio. We always have to keep 2-to-1 or 2 times coverage of our debt payments in a given year. I can send that policy to you, but that always has to be met. So it is important to know that that really only applies to our general obligation debt that's being paid with pretty much income tax. So that policy does not apply to debt that's being paid for by something other than income tax, or that's non-geo backed. So it's just kind of important to know.
Yeah. But, you know, I like, Steve, I like where you were going with, I think the concern, more holistically about the bond rating is probably focused on the cost of capital. You know, and there's a relationship between bond rating and cost of capital, but it may be more appropriate to talk about, you know, doesn't material impact the city's cost of capital or something to that effect. So we're not.
Or the other way I would put it is, it doesn't materially impact our ability to. It doesn't materially impact the ability of the city to borrow in order to meet its ongoing capital maintenance and construction requirements. I mean, really, that's what you're trying to get to. What you're trying to get to is this does not impact material. I think this is what you're trying to get to, is that it doesn't materially impact the city's ability to finance the remainder of the city's operations. It doesn't materially impact our ability to borrow for roads, streets, sewer. Well, roads and streets are the same thing. Roads, sewers, parks, those kinds of things, so that we can continue to fund our normal borrowing campaign. I mean, that's, I think, in essence, what you're trying to get to.
May I add, what about taking another approach and just saying something like, while protecting the city's bond rating, so that no one is boxed into a corner by very specific guidelines. The message is there that we want to make sure that we're not overdoing and negatively impacting the bond rating.
Let me suggest something just in the interest of time. I know I want to be sensitive to our 1 o'clock stop. Todd, maybe can you play with some options? Put your lawyer hat on and give us some options that I think we're all saying we want to give the city and their financial advisors some discretion here, and not hamstring them in, while also making sure that the city's well positioned to borrow at competitive rates in the future. And I think I don't know what that wordsmithing may look like. But Todd, maybe do you mind taking a stab at a couple of options? And Brent, if you've got something that tees off an existing policy, or, you know, has terms that the city's familiar with, you know, that may not be material, but maybe something that's used elsewhere in your policy, you know, send those around too, because to Steve's point, it's always kind of easier, I'm sure, for you folks to have consistent wordsmithing across multiple policies. And we want to, you know, realize that here.
Yeah.
But
And I guess the one other thing I would say is, you know, part of my challenge with this is, I'll draw a sports analogy. You know, focusing on the bond rating is like saying the team with the best field goal percentage in a basketball game won the game. You know, it's a good indicator. It's a good measure, but it's not ultimately the final score. And so that's, you know, if we can get away from focusing so exclusively on bond rating, I think that would, from my perspective, operationally, be a little bit better.
Yeah, and I was just going to add, I think this is a good conversation on this, because I think this is important to get this wording correct on this one, because if there's going to be an item that's picked on, it's going to be surrounding this. I can just see it right now that it's going to be this is related to issue, you know, you just passed issue 23, and now you're going to start paying more for capital and it uses our money less, and just on and on down the road. I can just say that this wording is going to be really important.
That's good insight, Brent. And so it looks like we got to do a little bit of work here. I think we hear the concerns about, we don't want to box this in too tight, and we need to provide some runway for the. So we'll work on that language. Was there any other thoughts or comments on the capital stack recommendations? We had, then we talked a little bit about the philanthropic dollars, was the last item there. But if there wasn't, we could move along to the operating budget. Okay. Hearing none. I know Todd just texted me and he lost his connection, so he's dialing back in, but we'll move down to.
Matt, I had just one thing. Was it always 10% or 5 million? Was there a fixed number on the philanthropic? Why do I feel like maybe I'm confused?
Linda, what we've used is 10% of the
Okay.
overall capital expense for philanthropic. But I think what's being combined there is that the city might also contemplate cash in that capital stack as well.
Okay, thank you.
And one other quick thing on that, should we clarify that it's 10% of the capital costs for the community center, not for the community center plus the office? I assume the office is a standalone. Yeah.
Something like that. I don't know if you can see my screen there, Greg, but
That's fine. So in round numbers,
I think that makes sense.
it's a $5 million number, plus or minus, more plus probably. So, okay.
Okay. Well, Linda, those were really good clarifications. So appreciate you taking the time to walk through those. On the operating budget, why don't you lead us off and just share some of your thoughts here? Linda's comments are on the red.
Well, I just thought that we should talk about, the business model that we were envisioning. And then, so that's the way I articulated that. In C is the city's historical operating subsidy for recreational services. So I wanted to distinguish that operating from capital here. And then if necessary, it's not a given, but if necessary. And then I wanted to just clarify again in regular people language, just adding reserve for replacement. And then the under E, what was it? We would recommend tiered resident fee participation, which includes a menu of options to accommodate our resident seniors. Then is there something below that? So those were just minor.
No, that's good. Those are all really good clarifications. I did, drop in a few of the, the cost recovery percentage that we talked about at the stress test level. I know we saw a couple of different models there run by Leon, and then the $500,000 approximately. I know that there was a couple of different numbers. I guess I would go, Brent or Dan, if you've got is that 500,000 tracking your latest thinking on the recreational services existing subsidy, or did that need tightened down a little bit? Just kind of scrolling back through my notes and had a few different numbers in that range jotted down between 400,000 and 500,000.
Debbie, are you on?
Yeah, this is Debbie. For clarification, I think what would be helpful, we know what we're talking about in this, but as this document moves forward, the recreation services is a subcomponent of the entire department. So I don't want anybody to think this is the entire department. For instance, our whole park operations department administration, it's all much higher. So recreation services, that is in the ballpark of what we are currently subsidized. I believe it's $530,000 in our 2020 budget. And these are the recreation services that are applicable to what would be a portion of a future community center. So we just looked at what expenses would carry forward. So this, keep it the way it is worded, does make sense with that. Now, I don't know if, Brent, Steve, Dan want to weigh in on, escalation. We do try to operate in the business model to where we try to hold that steady. And I believe with the addition of item A above, by having an actual recommendation to have a business model of competitive membership rates and cost recovery, that really sets the stage to achieve item C. Because A allows us to know that we have to keep our prices current with the market. And that is what we heard when we discussed with other communities, where they started slipping, is if they let membership rates stay steady for a period of maybe 10 years. Like you can't do that and then sustain cost recovery. So I like how you have A and C together.
So no, that's good input, Debbie. And just for folks that can't see the screen while she was talking, I dropped in a few, I think what I heard from you, Debbie, clarification. So maybe in A, say a business model based on competitive and market rate membership rates. So that we're making sure that on an ongoing basis, we're not only competitive, but you can be really competitive by going way below market, where we're sustaining it at something that's where the market's at. And then just clarifying in C, that the current operating subsidy in the amount of approximately 500,000 that we're talking about is a portion, is an operating subsidy for a portion of the recreation services. Does that help, or what do you,
I mean,
how can I better articulate your thought there?
Or the recreation services component of the department.
Recreation services.
I just wouldn't want somebody to pull up the department's budget and realize, no, the subsidy is much higher than 500,000. How does this correlate?
And can you give me the appropriate department name that would be consistent with your?
It is currently about 5 different budget components. It's the senior center, recreation services, our barn and shelter operations, and outdoor tennis. And the reason is because of shifting personnel around. So even though tennis has nothing to do with the community center, shifting a person who's a shared aquatic and tennis manager into aquatic only shifts around some of that collective subsidy. So recreation services, it simply differentiates from park administration and cultural arts. Those are the areas that are not included in recreation services. That may be a cleaner way to illustrate it.
I would love it. Can I maybe ask you to provide some clarifying language here on C? I understand I'm going to get it wrong. Let me put it that way. I'd love for you to tease out what that looks like. I understand the concept that you're driving at, though.
Yeah, and it may simply be an asterisk with a footnote at the bottom, so the sentence reads clean and is understandable and doesn't get too convoluted.
Okay. So we'll do a little bit of work there, but in substance, Linda or Brian, did you have any further comments on the operating recommendations? And I don't know if we've got Todd back on yet, but.
Brian here, just a quick comment that one of the things Steve said up in the capital portion, I think is important for probably both capital stack and operating, that, the intent of this funding mechanism, this whole thing combined, is that we're not going to negatively affect any of the ongoing planned capital expenditures for the city. And I think in the operating section, we're not going to, attempt to do anything where any current expenses of the city would be impacted either. That's a really important selling point of this, package. So I think if there's a way to weave that in, I don't know if maybe that would be, a follow-up statement after 1 and 2, but, I think that was the way Steve spoke, especially in the capital stack component, that, this doesn't negatively affect streets and sewers and that sort of thing. And I think, on the operating side, other than perhaps some of the, funds that would have come in from bed tax purposes that I suppose the city could have purposed for other things, that I think that's an important thing that people will be looking at. They're going to want to say, is this thing 2 or 3 years out, if it gets going to, affect other planned city expenditures? It should not.
Matt, I would just add to what Brian just said, that is pretty much what we're saying, alluding to is in C, is that we're looking at, this doesn't change the entire subsidy for recreation services as well as citywide. And it also illustrates a $500,000 subsidy shows an investment in service areas that may not be able to recoup 100% of the cost, such as currently with the senior center, having the senior component of a community center is typically what communities subsidize. So it allows that investment to continue.
I wish, I'm sitting here and I'm not coming up with the right words, but I wish in, let's see, where were we? C under capital and I guess C under operating budget. I wish there was a way we could say IE, and then that IE was, in other words, this additional funding will not, this initiative will not change the level of services received by the community at this time. It will only enhance it. I'm trying to come up with regular people words, because we're talking a lot of, city financing, budgeting jargon at this point. And I'm assuming that these directives will not only go to council, they'll make their way out in the wider dissemination.
So Linda, to put it in really basic normal people words, i.e. doing this won't mess everything else up.
Exactly. Why didn't I think of that?
So we'll work with the team and figure out something in between those two extremes.
Yes,
yeah.
Perfect. Yeah.
So Steve, what I'm hearing is there's an impact range on the choices that you make, correct? I mean, when you're looking at what you're going to do, you want to stay within an impact range. On that silly C sentence, couldn't you just keep it as it is? And when you get to, so utilizing existing excess city reserves and those in excess of 30% of the operating expenses, maybe clear that up a little bit, meaning you're not going to touch what needs to be done for capital funding in an acceptable impact range, and then just take the rest of that off, because then you're not, you have an impact range within the city on what you're willing to risk and not risk. So, to me, it needs to be a more simple, open-ended sentence rather than trying to determine how much we can do here. So I just think, from a contract point of view in real estate, you want it to be inclusive and not to take things out. And this does, to me, we know there's a negative impact, but what's the right way for the city to say it? An acceptable impact range or something like that. So now I'll be quiet.
Yeah. No. From, again, not to step too much into the discussions of the subcommittee, but yeah, if you're going to step in like that with those kind of ideas, I think you can step in like that all day. From my perspective, I think that was I think that was a good way to kind of formulate what I was trying to get to in my comments. So yeah.
And I like the reference to the impact on the city's services as opposed to a dollar amount. I think the word, I don't like the word subsidy. That's just my preference, because I think it's a negative word, but essentially people are paying their tax dollars, property tax, income tax, whatever, and parks is part of that. Part of what we're using their tax dollars for, just like police and fire. It's part of it. So I've never really seen it as a subsidy. I mean, you can only charge, the market can only take so much to have a program fail. So I don't know, so I like the reference to services, impact on services as opposed to impact on dollar amount or subsidy.
Well, Brent, that's a good point. I've been kind of listening to this challenging wordsmithing. It's also about making an investment in these services. Our tax dollars go to make an investment in services to, you know what I mean, that in our community. So the notion of, and that's authentic and it's honest, because that's, if you're doing it right, and we do, that's what your tax dollars go for. So just the notion of characterizing it as an investment, and not focusing in on the notion of a subsidy, I think is a good idea.
All right, so I did a little wordsmithing while we were talking. Those are really good insights, Brent and Marjorie. So I said, it is appropriate for the city's historical operating funding for recreational services component, approximately $500,000 per annum currently, to continue funding services at the community center if necessary. So really kind of pulling out the word subsidy, we have operational funding right now that's applied towards services. And then I think it was a really good point to frame this as, these funds are really supporting services. The location of the services is now changed. It's housed in a community center, but it is consistent what's been done historically, having that funding stream applied towards services. So.
If I could add,
And Debbie's going to add a really long footnote that clarifies that mess.
Well, I would just say the addition of at the community center at the very end, some of the recreation services are indoors and outdoors. Some of our programs will continue to be outdoors, and those could also be investments of services to our community. So the way I would see the way you have it is you're expecting us to have a $500,000 gap between revenue and expense at the community center every year. And I do not believe that is the case. What the collective recreation services may.
Maybe, okay, so let me play with that. I think what you're saying is don't tie it directly to ongoing services at the community center, but maybe say to be I have to play with that a little bit or work through that, clarify it. And
maybe it's just to remain, because it is appropriate for the funding for recreation services, approximately $500,000. I mean, you said it above that it's recreation services.
To continue if necessary.
I don't know. So,
yeah, let
me. Feel free to provide comments on that. This could use some cleanup, I'm sure. So, I think the high level, recognizing that this operating funding has been going on historically, and that it's appropriate for it to continue, just housed in a different budget line item. Is kind of what we're driving at, so that's helpful. So I think what I'm gonna go ahead and do here for my own reference, I think C in both capital stack and operating need a little bit of clarification, and we can work through that. I think that's really good discussion around both. Unless there's other comments about operating, I'm going to move down to partnerships, which is pretty light here. But I want to rest on it. Yeah, Tom.
And I apologize if I missed this while I was out, but at the senior center, there's a fair amount of CapEx need. When you talk about reserves, I think we need to think about both from an appearance and then how it fits into our recommendations. What is the true net effect of, or the incremental cost of the community center? And so not only do you have these dollars you're spending at the senior center that we're going to bring over to the community center, but we have the cost to the senior center. And so presumably there's a decent amount of deferred maintenance and CapEx being spent on those buildings, which are at the end of their functional use. So layering that into how this is presented to the community is important.
It's a great point, Todd. I think it's about $3 million in, if I remember the number correctly.
Of necessary improvements for the continuation of that facility. Then you have ongoing operating repairs as we deter those items.
Essentially capital cost avoidance.
Yeah.
Right. So I think that goes to the point that that 3 million probably goes into the capital stack. You're essentially going to repurpose $3 million from investing in these old buildings into new buildings. And then on the ongoing, you're going to reduce your maintenance costs, and that, you know, effectively it probably addresses some of the reserve cost as well as, you know, just reduced CapEx expenditures.
Yeah, that was a really good point. And I'm just thinking as far as a recommendation, I mean, really it's we've talked about it, but I think realizing that other folks are going to come at this from a more elementary, just without all the background, maybe setting the stage by saying the existing senior center, the use of it will be discontinued, right? That's certainly a recommendation that's implied throughout here. We could state it explicitly. I guess what I would, maybe some clarity around, you know, the effect of that will be reducing capital expenses, but I don't think, and Dan or Brent or Debbie, maybe correct me here, are you actually applying those cost savings towards the new community center pro forma? I don't think you are in any way. Okay.
No, we have a number. We know what's necessary to improve the facility, but as Dan mentioned, it is a capital cost avoidance because the facility we would much rather see what this task force recommends as far as the future of a community center. As you said right here explicitly, then discontinue the senior center if this does move forward. If it doesn't move forward, then we do have to address that $3 million situation.
Is there reserve balance? Do we have replacement reserves or anything, you know, segregated with respect to the senior center?
We don't.
No,
It's built into our general fund reserve.
Yeah. Okay, then perhaps, Matt, you're right that this is more just in the marketing of it, that we focus on a demonstration. I mean, a recommendation could be we recommend that, you know, the ongoing costs be the recommendations of the expected ongoing costs of maintaining the senior center be shown as being repurposed, but there's not a specific recommendation to it, or we just put that into our marketing materials.
So I'll drop some language in there for folks coming. I know we've got partnerships to get through, and then just to tease this out, since this is our last meeting before providing the recommendation to the broader committee, what I'd like to do is entertain a motion here at the end, collect some comments over the next few days, especially on item C, both under capital and operating, some clarifications, and entertain a motion to allow me to incorporate those revisions in our recommendations prior to going to full committee. So as opposed to calling another meeting of this subcommittee to approve the final tweaks here. But before I go there, let's just talk about partnerships. I really have kept it high level. And what we have
Hey,
now is
Matt.
partnership. Yes.
This is Nan. I also am hoping that we can get some direction on what this group would like to share at the community meeting tomorrow on all, what at a high altitude, I guess, what you want to include in that presentation of this huge amount of information that's available. So I don't know if we can get that in also.
We can try. Let's quickly touch on partnerships. I do have a hard 1 o'clock stop.
Okay.
But I think two things to say about partnerships. I've got a comment that Todd, you had leaned into on the partnerships. Do we want to explicitly highlight a desire to partner with best-in-class service organizations for, I think you were thinking the food amenities, food services amenities, and some other programming opportunities there. And then Linda, you had added the language or clarified the language here in red. So I'll just put a period there and comments on partnerships.
Yeah, I mean, I'll just quick, Matt and I had an offline discussion. We haven't spent a great deal of time in this committee on it, but I certainly would be in favor of exploring partnership options on food service operations, or potentially, if there's a game room or some facility like that, whereby, you're outsourcing some of the cost and there's a revenue share model, or, if there's a restaurant or a restaurant bar on the rooftop, things like that's outsourced, and you're not bringing those operational, requirements into the cost of the facilities and that expertise, which is very specific. And so I don't know what we do here beyond saying we continue to explore that and would be encouraging of that, because I don't know that there's time to do anything else.
So I'll just weigh in on this. I don't think that so if we get back to, this is a feasibility task force, those partnerships aren't going to materially impact the feasibility of this. I think there's a whole host of operational issues that go with those. So kind of getting you guys back to kind of core mission. I think that, I'll just be honest, I think that can set us up for a whole lot of complications and set some expectations that, looking at how the building's stacking, looking at what we can fit into the building, I don't want to set a level of expectations on a couple of those things that can come back to bite us later, particularly when you talk about food service and those kinds of things. Operational kind of things that are core to the operation of the building and core to particularly the fitness elements of it. Yeah, we're exploring that kind of stuff, but some of those amenity partnerships, I'm a little concerned about having language in there that kind of ties us to head down that path.
Matt, was this section intended to also essentially by reference speak to the private office space, or is that something outside of this? And I guess where I'm going with this is that I think it's not just operational funding that may come from the partnership, but it potentially could be capital.
This would be the appropriate home for it, Dan, to your comment. I believe, and I'm going to just, I believe that initial iteration there just said speak to lease third-party operating partners as a placeholder. So I think, yes, this would be an appropriate home to it.
I guess I would encourage you to consider the wording of that to be operationally and capital funding or something like that.
I empathize. I understand where Todd's coming from, especially with a hospitality background, that you know, your food service amenity is going to be an important program offering. So I don't want to discount that at all. Logistically, it may not be viable, but I think it's something that at least exploring whether the food service is an internally, whether a partnership opportunity makes sense there or not, I think has a lot of merit in a hospitality setting, which a community center's got a lot of hospitality components layered in there. So, but I think I wouldn't want to be prescriptive here, Steve, to your point. I think it's more, and Todd, correct me if I'm wrong. I know, you know, you shared some of those thoughts. I think it's more about the exploration of the opportunities. I know we didn't have time given, you know, that the limited scope of this group, but it was something that you had mentioned.
That was the intent of the comment. I mean, I certainly, and that's the objective of it. You know, I sort of empathize with Steve's, you know, directionally concern as to where it goes. And some of this is because we're dual tracking it, you know, being up to date on the facility design and how it's going to work and all those logistics, recognize there's policy decisions there to go there. I mean, I do think just from an intellectual standpoint, what overhead and CapEx goes into the design and budget does impact the feasibility of the project from an overall cost standpoint. So I hear that. Obviously, we have to be practical in how we marry this up. So I'm not wedded to it, but I do think it is an important element.
Yeah, I hear you.
And Matt, I know everybody's got a hard stop at 1. I wanted to get back to the comment that somebody raised about what we present at the community meeting Wednesday evening, because it's likely to be Nick and me, you know, giving an overall update on all of the aspects. So this conversation underscores the incredible work that's been done, but also some of the questions that still remain, not surprising. And so I just want to make sure that we're calibrating kind of what our presentation is. And I know we won't solve that here, but if you and the members of the subcommittee feel comfortable enough with us working on that sort of general framing of where you are and as well as where the facilities committee is, you know, and community engagement, I just want to make sure that you have a comfort level that we're just not quite there, and that's okay. And we just need to report out to who's participating tomorrow.
Yeah. Margie and Nan, would it be fair to say that around this subcommittee's work product to be shared tomorrow, the one component would be a high-level financial overview, and the second component would be simply laying the groundwork for what the subcommittee's working on is recommendations around capital stack, operating, pro forma, and long-term partnerships. I mean, do you feel the need, I guess, to go deeper than that? I'm not exactly sure where the other working groups are on their presentation, so want to make sure we're cognizant of kind of walking in lockstep with them.
Right, exactly. I mean, so that there's a seamlessness to the presentation in terms of an alignment between the work of the different subcommittees, which there is. It's just not quite all there yet. And that's, as I said. So, and Nan, let me let you answer that question. If he was,
I guess I mean, you guys have done a ton of work and you've put a lot of, you know, the basics are there. So I guess the question is, do we just share that this is still in progress and that, you know, there's going to be a task force meeting next week where it'll really start to come together more fully? I mean, I would think we would talk about membership rates and some of the basic tenets of how this is going to be put together, but not get into the weeds of all the details. What we have in the presentation right now is kind of the 2 slides that, well, the membership rates, the 2 different slides on the format that show kind of the 2 different scenarios of the stress and the higher performance. We aren't really talking about how the project is funded or the TIF funds or any of that at this point, at least in terms of what's in there currently. And we're going to have the facilities committee kind of preview meeting later this afternoon, and we'll talk about some of this there as well. But and a facilities committee meeting tomorrow before the community meeting. But we need to really just be sure that we're hitting what we need to hit at this community meeting. And there will be those other 2 meetings that will be public meetings as well. But just any questions that would be raised before council.
Yeah, I Matt, liked those 4 or 5 categories, those high level categories that you mentioned just a minute or 2 ago before Nan's comments. So I don't know how those, to acknowledge these are the key areas, that will, that reflect the work that we've done from a financial perspective. Can't remember offhand what they were, but and combined with generally what Nan is indicating we're going to share facilities perspective.
It could be, I know we're a couple minutes over 1, but it could be that I could send to you, Marjorie, and then just, these recommendations, but backed out into questions, right? So under capital stack, we're saying, is this an appropriate, turn these into questions? Because these obviously haven't been reviewed by the full committee and are still subject to further discussion. So maybe just bulleting 1 or 2 questions under each of these. What is the appropriate cost recovery, for example, under operating expenditures? Should we be budgeting for ongoing capital needs? And just give a quick, really high level overview of that if you wanted to give the community a sense of the product that we're driving towards.
Well, I think those are definitely the types of issues, and whether you want to pose them as a question or you want to share just kind of what your current thinking is around that.
Yeah, I guess this is a question for Margie on what kind of where the facilities committee's at and the community engagement. It feels a little bit premature to tomorrow to be positioning conclusions before they've been reviewed and thought through by the entire committee separately. But
yeah, that's intuitively what I'm sort of trying to process myself. And Steve, I don't know what your thought is, on this from your perspective.
So here's what I've heard from here's what I think, what I'm hearing from this subcommittee, and I think what we'll hear from the facility subcommittee. I'm hearing that from an operating standpoint, your analysis shows that the facility as envisioned can be operated at fair membership rates with minimal risk of requiring additional operating investment from the city beyond what is already invested in our recreation programming by the city today. I think that's core number one. That I don't see anything happening in a discussion with the whole task force that changes that conclusion from this group. I think the other thing that I've observed in the discussions from this group and the analysis is that at the $50 to $55 million level, that this group concludes that if the analysis continues to show that making that investment won't have a material impact on other city operations and other ongoing capital maintenance and other ongoing capital investments, that that you all believe that that is within the realm of possibility. I think if those are the two top line conclusions that I'm hearing and I'm seeing reflected in those recommendations that we've been talking about, for a community meeting at this point in a process like this. In my opinion, it is perfectly appropriate to share those two findings of the subcommittee. If you all agree that if I've summarized your findings accurately. So I guess there's two questions there. Have I summarized them accurately? And if so, are you guys comfortable having that reflected out to the community?
Steve, sorry to be dense. Can you repeat the two, just the two again?
I was afraid somebody was going to ask me to do that.
Thank you so much.
So the first one was, I knew you guys were going to do that. The first one was that you have the task force has looked at the numbers and concluded that at a fair cost, at a fair membership level, the community center operationally can operate in a way that does not put the city at unacceptable risk for having to put more investment in ongoing operating expenses beyond what is already invested in those recreation program and beyond what is already invested in recreation programming today.
And you're confident about that.
And maybe just to tighten that out, Steve, just to say, because I don't see tomorrow that we want to get into what the historical operating spend has been by the city and services. So maybe just to say, at a market rate membership level, the community center is operationally feasible, period. And just to simplify it, I mean, I know that the nuances of carrying over, historical operational revenue will be there at the final recommendation. But if we're just trying to put a cap on some thoughts, that might be a simpler explanation tomorrow.
Yeah, and again,
the rest of it is without raising taxes.
Yeah, and I was gonna say that might be the first recommendation we say is that the financial, the subcommittee will recommend that the project proceeds so long as there's not an ask to increase property taxes, or however we want to phrase that. But I think leading with that, and that was kind of the initial conclusion we all jumped on day one in this subcommittee.
So to kind of get it back down, and I won't go as simple as I did on the one earlier comment, but it boils down to without raising taxes, we believe the following things can be done. One is the community center can operate with basically spending similar amounts as you do now on recreation programming, assuming assuming market rate memberships, and we can outline, and I do think it makes sense to dive into what we mean by market rate membership rates, because that's going to mean a whole lot to a whole lot of different people. So I think it does make sense to go back through Leon's analysis on membership rates. Number one. Number two, if you guys agree with this, that financing the construction of the community center with existing resources, private donations, and TIF revenues is feasible.
Steve, just in the interest of kind of having the full intellectual debate here, what do we think the policy objective is for going on record? Back to Matt's point, is whether it's premature, but like, what's the benefit in your eyes, and what's the risk in your eyes of taking a position, prior to the full committee deciding it? And obviously you're qualifying it with here's where the finance committee is going.
Yeah.
But at this stage of the process, what's the benefit to us?
So let's back up to the purpose of tomorrow. The purpose of tomorrow really is to educate the community in terms of where you all are in the process. So we're not at the point where, yes, there will be an opportunity for some feedback, but really I think it's fair to say the task force has pretty much, the subcommittees and therefore the task force as a whole has pretty much concluded your research. And so tomorrow night is really about sharing with the community where you are and helping them understand the process that we've been through a little bit, but really it's more about sharing where you are. So, and this is, you know, in terms of we all know, we knew we needed to do 3 things at the end, and how you put them in order, there's never a right answer. We need to do a community meeting, we need to do a task force meeting, and we need to do a report out to council. And one of those things has to go first. We, you know, through the process, somebody chose, I think the collective we chose to put the community meeting first. And then the next thing is the final task force meeting, and then the report out to council. So there is always a question of, well, how much do we say at what meeting? And, you know, is this jumping the gun over this other meeting? And there's not a right answer.
So we right now have 4 slides, and I could share my screen, but there's basically a facility operations slide that shows the hours of operating, that the core spaces are incorporated, that revenue comes from, you know, a variety of sources like admissions and passes and memberships and programs and rentals. And then that the expenses and are based on like comparable costs with similar facilities, and that the cost recovery goal is 80% or better. I mean, that's all in one slide. And then we go to the membership rate slide, and then we go to the 2 pro forma slides at the full potential and the conservative, which just show that cost recovery varying between the 77% and the 110% or whatever it is, 103%. So I think we can keep it high altitude and not really make recommendations till the task force has really weighed in, you know, and accepted the recommendations, if that's what you want to do.
I'm open to the thoughts. Just one thing reflective on what you said, Nan. I'm not sure I would go into the cost recovery models. I mean, that feels pretty weedy. I think the statement of, you know, something around the effect of an 85, you know, based on these membership rates, and to Steve's point, giving folks transparency into the membership rates that we're anticipating is really important. But, you know, we are anticipating an 85% plus cost recovery. Feels like that's saying enough. It feels like we're going pretty far down in the weeds to give the stress test, but I mean, I'm really interested, Brian and Linda and Todd, if you've got thoughts about where to land on the just 2 high level anticipated conclusions. One about the, you know, the market membership level of the community center. You know, I tried to summarize what Steve was saying. I said at a market membership level, the community center can be operational feasible. We anticipate that maybe as the qualifier, and then the qualifier maybe we anticipate that utilizing TIF proceeds, existing reserves, and philanthropic dollars, there appears to be sufficient financial, you know, sufficient ongoing revenue to fund the capital cost of the community center.
Yeah,
you know, those two kind of statements, being out there as overarching statements. I don't. What's the comfort level of the group about presenting those tomorrow?
I'm fine with those. I think for a community meeting, what people want to hear is no more. I'm not being asked to pay more in taxes. How much would membership be, and when's it going to open? So I think those larger statements are just fine.
Yeah, Matt, I'm comfortable with that as well. I mean, I think one of the questions that is likely to generate after, you know, people listen to it is what we've talked about here. Okay, you know, no taxes, that's great. Is there a chance this is going to affect other city services? You know, we don't think so. And I think, you know, somebody could ask, if the projections aren't met, is the city a backstop? But, you know, the city, I think, knows that question's potentially going to get asked anyway. But, you know, based on the data we've been presented, I think that's an accurate depiction.
But Brian, maybe to your point, I think with this kind of uber educated community that we're in, being able to at least orally speak to the fact that it's been stress tested is going to be of value to some people who are listening. know that we've looked at kind of a worst case scenario.
Dan, one thing I don't understand is where we address the proposed office space and how that impacts the project. And I think Dan brought that up under partnerships, you know, is that more operating? Where is that in all of this? Because the one question I do hear out there is, why are we putting office space? Why are we building it so high? So, you know, I think we need to answer that a little bit here. And I think going to the community first is better, because that's what we've said all along. We'll get their input every step of the way and hone what we come up with from their opinions of where we are. But how, Dan, does that impact? How does the office impact operating or building or whatever?
Well, as you might recall from the discussion about the capital financing right now, and we're kind of doing a parallel process with Pizzuti Solutions, unrelated to Margie. I have to repeat that, to evaluate the office model. And, you know, we think that we're going to see a pretty high level of interest in that office space, given its proximity to amenities. But right now we're projecting that that could subsidize the capital stack to the tune of about $250,000 a year, and help finance the construction of the community center. And I think that's the takeaway for why the office is beneficial. And then you can talk about the income tax that might be generated from the site, things like that.
Maybe said another way, because this is the question I've gotten a few times, Linda, is the $10 million associated with the building of the office space is anticipated to be covered by the tenant revenue from the office space with excess. So it pays for itself, and it might have some excess, but I think that's the question I keep getting is, you know, is the office space, how are we paying for the office space if we were to set that aside separately? Maybe that, you know, going to the partnerships, that last recommendation, that might be a worthy bullet to speak to where we anticipate that going.
But Matt, is the community correct in the thought that they have right now that doing the office space is what's going to help build the community center and cover costs of that? I think we need to address that a little bit in what we're saying.
So Brent, when you pro forma this, is the net revenue from the office space doing more than covering its debt burden?
Yes. Yep.
Like significantly, or?
Yeah, just like Dan said, it's about to the tune of, you know, $250,000 using pro forma. We're using, you know, current projections and current rates.
Over and above the debt service associated with that 10 million. Okay.
Yep.
Thank you. That's helpful.
Another pragmatic question I guess I want to ask, because I know we're way over time, but who is presenting this information tomorrow? I know, Matt, you said you weren't necessarily available to do this. How is that being processed?
Well, certainly.
Man, are you presenting? Is that what you were generally thinking?
You know, we can handle it however you'd like to handle it. If you want it to be exclusively by consultants, we can handle, you know, that whole presentation. Either me or Aaron or Leon is who's going to be speaking tomorrow from our team. And, you know, or if someone from the committee wants to speak to that too, that's fine.
And I appreciate that, because that's the reason why I raised this in preparation for that meeting. I really believe it needs to be a balance, because it needs to be a balance of the task force owning it with the support, the really valuable support of those consultants. I just feel a level of discomfort of having it all presented by the consultants. And it could be a 70-30, you're doing 70 and we're doing 30. I just believe that, first of all, there's a lot of work that's been done by the task force members, the subcommittee members, and both facilities and finances. And so I'm just trying to find that balance in terms of how we present and who owns this ultimately.
Yeah.
So, you know, so maybe we can figure that out. And, you know, Steve, you and I had a conversation a little bit about this as well, in terms of how you calibrate it authentically. You know, it's been all hands on deck. It's just, how do we characterize this so that the task force has a level of ownership? So we probably
So
will.
let me ask this: if and again, I appreciate everybody having cleared at least one meeting off your schedule at the last minute here by going over 20 minutes. If anybody else on the task force is, I do think having a task force member be the one who kind of sets the stage for whatever presentation by Nan and company, I think is important. So I guess we would ask for, I think asking for a volunteer on that is appropriate.
Yeah, I can do so. Do we have an agenda that's been circulated for that yet, so I can get a sense of time? I will be on the call. I will be chasing two kids around the house, so I'm just trying to figure out where I may fall in that, when I need to turn my screen off for the sake of professionalism.
We understand.
Yeah,
So,
we do have an outline for the meeting tomorrow, and in fact, I was supposed to be meeting at 1 with OHM to go over that, and we'll be doing as soon as I'm done here. Right now, these slides are like, we have probably too many slides in. We have 66 slides, and you know, the facility stuff starts at 58, you know, so yeah, so it's later in the presentation, but we're recapping phase 1 and then getting into phase 2. Just in case somebody hasn't been there for the whole ride, you know.
well, I'm happy to tee it off, and as Margie said, maybe do 70-30 kind of thing. You know, Nan, if you'd be kind enough to put the slide deck kind of together for that portion of it, and then I can introduce it and maybe let you run it and go from there. Does that sound similar, Greg, to kind of the approach you folks are taking on the facilities committee? Just want to make sure we're being consistent.
Yeah,
Okay.
We'll probably give a kind of an overview, and the consultants, Nan, will go through the nuts and bolts of it.
And I don't think we need to spend a lot of time on phase 1. We've really reiterated that at a lot of different forums and meetings. I don't think that we need to go into painful detail about great stuff, but about what we did for phase 1. And if others agree, I think we need to focus in on facilities and finance. Just my thought. So that might reduce some of your slides.
Yeah.
With one possible exception, Margie, which is talking about what the facility in terms of square footage looks like, right?
Yes, absolutely. Yeah, I'm just focused on all the outreach that we and the survey, the qualitative and quantitative survey work, although I know we want to report generally back on this last survey that we did, at a high level. However, absolutely, I think they want to see, I think that's really important for them to see what's in the building, what we're proposing. Is that what you're saying, Dan? Is in the building? Yeah, I absolutely agree with that.
Matt, can you send the bullet points that you wrote for the 2 points, or do you want me to craft that based on the notes I took?
I can, if I can read my chicken scratch here, I'll try to type it up, send it to you. I'll shoot something over to you.
Okay, great. Thank you. Okay.
All right. Well, I know we've got a couple other folks on the line. Any closing comments from other committee members, Linda or Bill?
If I can make one closing comment, and I'll keep this as short as I can, and it is a very, very sincere thank you to this subcommittee and to all the subcommittees. I've been through a lot of processes in my career, and very rarely do they actually work the way they're supposed to, in terms of really getting strong input from a community task force and a community-based committee like this. And, you know, I always judge a group like this in terms of, number one, have they made us do a better job? And number two, have they brought to the table things that we never would have thought of? And I think you all have met those two standards in spades. And I cannot thank you enough for the amount of time and dedication and work that you put into this, because this truly has been a process that has been driven by you guys. You've asked for our help. You've asked for it in ways that have really made us raise our game up and do a better job on things. So I just want to take a half a second and say thank you.
And I'll ditto that and then some as a co-chair. So thank you.
Well, I appreciate that. It's been a really informative process. And I know we all now, as Todd has evidenced for us all, we all now have great screensavers as part of our participation in this exercise. So it's an unexpected bonus.
You can't say we didn't learn something, right?
Yeah, Todd, no more of those fancy hotels. I expect an Upper Arlington background on all your Zoom calls.
This has been on some of those meetings. So my ability to set it and then my ability to change it are two different things.
I think Jeff noted we do have a speaker or some comments. Jeff?
We do, yeah. Mr. Carney, you should be good now if you want to unmute yourself.
Thank you. My wife and I have lived at 3101 Bembridge for 26 years. My wife went to school here and my kids all went through the school system here. And so I appreciate you giving me an opportunity to share some questions. Mr. Cass has stated that City Council is driving the size of the Macy's redevelopment. And that larger size apparently will allow the community center to be included in the redevelopment without raising taxes. You folks talked about that for a portion of the meeting. There is a real concern about the size of the development. Folks have talked about a lot of different subjects, but really my neighborhood and the neighborhoods around the development are concerned about the overall size. And you can't, there's so many other things that people talk about, but that's the basic argument. But has a study been completed to determine whether the proposed development will do that or whether something smaller will accomplish the goal of not having new taxes? So I know I'm not supposed to ask questions because you don't answer them, but it's something that I think should be considered. You folks are the finance people, and hopefully that's a question that will help us determine whether there's a compromise that everyone can live with, because on our side of the table, no one is talking about that problem. No one's wanting to negotiate. I specifically asked that question last night of Kip Greenhill, and he refused to answer it. He's not willing to negotiate on behalf of the smaller community that surrounds the development. And I find that a little disturbing and somewhat sad. I mean, I don't think anyone wants to shut it down completely. They treat us like we do. We think that it's important to get rid of the Macy's, to get rid of the eyesore, to actually put something there that'll drive revenue. But you have to take the local community into consideration when you make these decisions, and that hasn't been done. So that's why I asked that first question. The second question is, has any thought been given to using both Macy's and the Municipal Service Center sites in maybe a dual development to reduce the impact on Kingsdale? I don't know how you would split those out, because there's a lot of synergy that goes with having the community center with office space where employers can offer that as an amenity, as well as a senior community center with senior living, and the apartments that might take advantage of the community center as well. So it works very well together, but that might reduce the size and therefore the congestion at Kingsdale if you split it between the two locations. Might mean a little more money in terms of expenditure from the city coffers, but certainly it would be amenable to the surrounding location, because really we don't want to put in a senior center and a community center that enhances the entire city, but reduces the surrounding community in terms of livability and walkability and safety, congestion, all the things that we deal with on a daily basis because we live here closely. So I'm hoping that I've made a point that folks will start to consider, because it's really, I think we're giving a lot of time where we can talk, but nobody's listening. And I'll shut up.
So Matt, if you want, I can answer some of that, if that's okay with you.
Yeah, feel free to, Steve. Mr. Carney, I'd just like to say thank you for taking the time to listen in today and to share your concerns. I think that we value them. I know that the folks on this subcommittee and on the committee at large value the feedback that you're giving, and we're listening to it. And I think that although the answers may not always be congruent that we certainly appreciate you taking the time to listen, and we're ears here. This process has been about a lot of listening from this subcommittee to community concerns and also to community input. So we certainly appreciate you taking the time and carving it out this afternoon for us. Steve, you may be able to speak more clearly about the dual development concerns.
Yeah, to put it in pretty simple terms, we've looked at the numbers, and it gets really, complicated. And I'm doing this off of memory because it's been a couple of weeks since I've looked at it. A unit of in the standard apartment building generates, I want to say, about, call it $3,500 a year in taxes, real estate taxes. A unit in the senior building, I want to say, generates around $4,000 a year in real estate taxes. And that goes into the TIFing, that goes into the financing. I will tell you that we do not have a ton of room in our model for we need every revenue source we've got. There are some other revenue sources that we could go to that were outlined in the last subcommittee meeting, that, if we do have a shortfall in sources for debt service on this, that we could go to. So, as we've talked about in the facilities committee a couple times, we're trying to be really conservative in all of our estimates so that when we get to construction documents, we don't have some kind of a massive surprise. So we are looking at all the time, what are the sensitivities to, if you do this to this project, what happens here and what happens here? Is there a ton of room in our pro forma that would allow for, a massive reduction in size of the buildings? No. And there's not a ton of room in Mr. Cass's pro forma that would allow for a massive reduction in the size of those buildings either. So I guess that's the easiest way, the quickest way to answer your question. Yeah.
Were there any other questions, Jeff?
No, that was it.
Okay. Well, if there's no other questions or comments, I entertain a motion to adjourn.
So moved.
All right, so moved by Todd and seconded by Linda. Thank you, Brian, for your time as well. And we will all see each other tomorrow night, I believe. So take care.